My name is Mrozowski. I'm a Polish guy off the boat from 1982, and for the last 40 years in Silicon Valley, 35 years active and doing my own engineering startups. And probably one of my biggest claim to fame was the helping out a little company called Netflix to get established. And then from one of the co-founders of Netflix, we started our own fund, Silicon Hill Ventures. And ever since then, I've been involved in IoT, healthcare, and fintechs, and I'm doing advisor for the company for the fund called Inspire Global Ventures that actually originated from here, from Marty's network. But anyways, enough about me. I wanted to introduce the panel, which is more qualified and right on the target of what it is that we're going to be talking about. So I will start with Peter to have a little brief bio on yourself. We'd just go like.
Good morning, everyone. It's Pete Thurlow. I know both. I'm sorry, let me put this. I'm not used to speaking. It's very nice to be here today. Many of you know I normally host the meetings in my office at Polsinelli, but it looks like we got some really good competition here from Chico because the space is beautiful and it's really nice. So thank you very much for hosting. I know it's not easy. It's great to be on the panel. Great to have this discussion. Many of you know from early discussions, my expertise is really as an intellectual property patent attorney. I've been doing that for 25 years. I was at a big law firm, Jones Day, where we were buying companies. 8 years ago, I joined a Midwestern firm. Now we're up to 1,000 attorneys and 23 offices nationwide. But the way I tell the story is that 8 years ago, as important as intellectual property and patents are to companies, I quickly realized working with startups and early stage companies that they needed capital. So I met great people like Marty and others and family offices. I didn't know what that term was 8 years ago. And I just started hosting meetings and Shark Tank-like meetings where I connected founders to family offices and then family offices to good deal flow. Last thing I'll say is an intro. Some of you may know I was in the military and I serve as an advisor to DARPA, Advanced Research Projects Administration. They've spoken at Marty's meetings several times and always enjoy it. And we can get into that more as we have our discussion.
Gosia.
Thank you, Arthur, and thank you, Marty, for having me. My name is Gosia Karas. I am a co-founder and GP of a new fund called Actuator. So the intro here on the list is slightly outdated, but I did spend the last 5 years at Softbank. So I switched away from doing growth stage investing into going slightly earlier stage. The new firm is focused on early stages. We invest from seed stage to Series B, in particular in seed stage, and then re-underwriting the deals at Series B. It's being built by myself and my co-founder, Will Foss, with whom we worked together at Softbank. My story while at Softbank was actually building funds for the firm. I was on the founding team of the Latin America Fund, which we established in 2019 and became a very successful fund. For Softbank itself, it was a structure of a single LP fund. So the capital was coming from the firm of the balance sheet. But other than that, it operated as a traditional venture capital fund. And the other one, after spending a while in LATAM, I switched back to doing US investing and going slightly earlier stage and investing in kind of companies also from seed to call it Series C through a vehicle called Opportunity Fund, which I have co-led. And my partner, Will, is a robotics specialist, and the fund that we're building is within AI and robotics. His largest claim to fame is working as an operating partner and investor in Boston Dynamics, which was a portfolio company of SoftBank, which he helped build from 0 revenues to high double digits, which is where it is right now. It's actually above that already. So a hugely successful story. My background from before venture is in private equity. I worked for a while at a firm here in New York, actually, a Canadian firm called Onyx Partners. I was on their deal team, on their large cap deal team within the firm. And prior to that, I started my career in consulting, working for Bain & Company. I am originally Polish as well, just like Arthur. So there is a bit of a Polish mafia here on the panel, I can say. I grew up there. I did my undergrad there in statistics, and then all the way up to a PhD in finance. And then I moved to America and did my MBA at Harvard in 2017.
Well, thank you, Gosha. Appreciate it. And then Anurag,
Good morning, everybody. So I'm originally a New Yorker and proud of that. However, my last 30 years now have been in Silicon Valley, and I'm very proud of that. I really enjoy being a part of the dynamic entrepreneurial community out there. So in that time, I'll start with where I am currently. A friend of mine, an entrepreneur for 20 years, sold this company about a year and a half ago. He asked me to come help him set up a small family office for him. What's notable about that is we did his liquid strategies just to make sure his wife would be happy, but then the rest of the capital is in an attached venture studio. So we are investing in 6 or 7 ideas that are passions of his, and we're building them slowly but surely, and at some point we'll raise outside capital. My career, I've been in 4 venture capital funds. I have this schizophrenic background. I've been a GP, and I'm currently also an LP, and I'll talk a little bit about that. But the 4 funds are about $2.5 billion under management. I've probably deployed about $400 million in direct investments in my career, early stage to growth stage. I've been in 3 startups, never a founder, but always reported to founders or CEOs. 2 were sold to public companies. And the third was, as I've told my co-panelists, a spectacular failure. But you have to have one of those. And then for the last 7 years, I've been a trustee for the San Jose Pension Plan. It's a $10 billion plan, and I chaired the investment committee. And about 4 years ago, we relaunched the venture program. Proud to say it was this part's not, and I'm not proud of it. It was the worst performing plan in the state. And then 3 years after I took over as chair and we hired a world-class CIO, we became the number 2 performing plan. We've added about $1 billion in AUM in 4 years. So.
That's great. Doug, we're connecting. You're in Arizona, right?
Yes, I am. Hopefully, everybody can hear me.
Yeah,
So,
it's all good.
Yeah, no, it's thanks for having me, and I'm sorry that I'm not there in person. It was sort of a rather late edition, but it's an amazing looking conference. I hope to be there in person going forward. First of all, happy Valentine's Day, everybody. If you've forgotten, I see some lovely orchids behind Arthur there that if somebody turns their back, you can take them home. So I'm one of the founders and general partners of Xcellerant Ventures. We are a healthcare-focused venture capital fund here in Arizona. And as Marty said, we've got a lot of degrees. I'm a lawyer by training. There may be a Polish mafia on there, but I know there's 3 lawyers on the stage, Gosia, so be careful. And of all kinds, I'm the worst because I'm a lawyer manufacturer. I've been a legal academic for 20 years, and I was dean of Arizona State University Law School for the last 11 years, stepped down a couple years ago. And one of our alums who has way too many degrees, he's an MD, JD, MBA, John Schufelt, originated urgent care and digital health platforms like MeMD that were recently purchased by Walmart. We all decided to start a venture capital fund, again, focused in the areas that we knew best in healthcare technology. So that fund launched a year ago. It's been a fun time fundraising this year. I'm sure everybody will nod. But we've had, I think, some amazing deal flow and really interesting ideas. Prior to the venture capital life and my academic life, I was a lawyer at Baker McKenzie in Chicago during the dot-com boom. You can probably tell why I became an academic again in 2002, because the dot-com bust hit right about then. So when my time at ASU, I've really focused on entrepreneurship, innovation, intellectual property. And so this is a wonderful opportunity to get back to work with founders. I've been a founder myself of 3 different companies, one that's currently raising, and I know what that world looks like as well. So really happy to be here and talk more about venture capital. It's an amazing panel, and look forward to hearing everybody's thoughts.
Oh, thank you very much, Doug. So let's get this thing rolling. As we know right now, the venture capital is kind of downsizing, and even like big guys like Tim Draper, he's raising the small seed capital. There's round C, D, and F, kind of like unfulfilled by lack of the dry powder. But overall, the industry seems to be doing fine. It's redefining itself. It's more focused, like I suppose, on early stage. But question to you, Gosia, like where is your focus like right now? Where do you think that the VCs are interested in investing their monies, and like what sort of industries are we talking? AI, robotics? Where is it going?
Yeah, of course. I mean, definitely AI has been kind of all the rage since ChatGPT became a thing, and it got to this 100 million users in in a couple of days, and people started to realize that, there is this magnificent technology out there that just has been kind of flying out under the radar for a bit. So this has been a kind of a bright spot, I would say, within the venture ecosystem broadly, because valuations went down, the activity went down around, call it end of 2021, and this was this one kind of area that hasn't really been affected by it all that much. I mean, valuations for AI startups have been through the roof, which to some extent is driven by the kind of search for yield, if you will, and search for what is exciting. But to the other extent, also just by the fact that, if you think about foundational model companies and a lot of stuff in AI more broadly, it operates more like deep tech rather than like software. I mean, there's just so much money that needs to go into training models. Still, the cost is going down, but there's still that component. I mean, that was the core reason why OpenAI was raising at those kind of crazy numbers already since its beginning, because it just costs so much. But the enthusiasm seems to still very much be there for the companies within AI space, perhaps a little bit slower in terms of the foundational models just because of where those valuations are. I mean, OpenAI has been raising money now at $80 billion valuation. They started this fundraise when it was a ballpark of 70 times multiple of their rolling revenue. So very, very expensive. Now, of course, they are growing up to hit that valuation in terms of their current revenue numbers. But there's some skepticism in terms of valuations, which I think is well-founded. But it is still very exciting just because there's so many killer use cases for AI kind of across the board in terms of increasing productivity from customer support through healthcare, through fintech, really kind of across the entire economy. And for me personally, having been in this space for a long time, and I've been building my thesis around it and being plugged into those networks for the last decade, what has been quite fascinating is that it took so long, because the foundational pieces of the technology have really started to be built in ballpark 2012, right, with the deep learning revolution and the recognition of cats in images. This was like the most famous use case about a decade ago. And then through transformers in 2017, which is the core underlying technology of the large language models. Nothing has really changed from the tech standpoint within that universe since 2017, since the transformer paper came out. But what OpenAI did really, really well was getting to that broader attention and really making folks across the board realize how exciting that technology is and how much can be done leveraging it for various use cases.
Yeah, I think it has to do also with the silicon, meaning that, we grew into the level where the silicon could support all those big data sets and had the appropriate speeds. Because when you talk about, technical algorithms that were built into the AI, they existed in the late 50s, right? There's nothing really new there. It was just the power of a computing and an ability to access the large petabytes of data.
For sure. I mean, definitely the NVIDIA CUDA architecture was the huge driver, right? That you can repurpose GPUs from video games predominantly into something that can be used for computation. That started to happen, call it 2012-ish on a larger scale. So that was a huge driver. And then the amount of data that you can actually feed into the GPUs and train larger models.
Yeah, I wanted to ask Anurag, because the whole thing about the Silicon Valley and the transformation, or where is the money coming and all that. I mean, it's very cyclical, and we knew the .com bust from Doug and everybody else, but we're in some kind of a cycle, and what would you define we're in the cycle today when it comes to the venture capital in Silicon Valley?
Yeah, unfortunately, I'm old enough to have lived through the last two downturns, 01, 02, and then 08, 09, 2010. This one is bad. It's not as bad as the prior two. I think there are more obvious tailwinds in a few really important sectors. So Gosia's already talked about AI. Autonomy is another big one. Robotics is just continuing at a torrid pace. The product development cycle is slower because it's hardware, but and these markets I'm going to just reference off the top of my head, I think are all trillion-dollar markets. Space technology is another huge one. We've had several panels yesterday, and I guess we'll be talking more later in healthcare. Computational biology is a revolution that's happening. And although I'm not big in it, but AR VR is actually something that I'm pretty bullish on. And a lot of folks think, oh, we don't like using the devices. It's a bad consumer experience. It's going to revolutionize like the Zoom experience in an office. I've already seen really good product that's coming out of Silicon Valley. So, and then there's all the existing themes, fintech, traditional B2B software enterprises where people are still innovating. So you've got those tailwinds and you want. And so right now, I think early stage venture is a great place to be. There's a lot of data that shows going back to the late 70s, early 80s, Microsoft was founded, as well as Oracle in a recession. A lot of data on the semiconductor companies that came out of the recession in the late 80s. And then more current for me, in 2010, we had Airbnb, we had Uber, we had Lyft, we had Stripe. All of these are decacorn companies. And so I think you're going to see that phenomenon again. Venture is washing out the old capital, which invested at absurdly high valuations in 2020 and 2021. And so companies have been extending their runway. They've been letting people go. But in 2024, they're going to have to come back to market and raise it down rounds. That's not necessarily bad either. I missed out on OpenTable in 2004 because it was a dot-com bust and none of my partners wanted to invest in the internet. And Bob Cagle at Benchmark told me we were making a mistake, and he was right. And then in 2012, I had a chance to invest in Dropbox, and I thought this one, storage is going to commoditize. How's this possibly going to be a successful business model? That ended up being a unicorn exit as well. So there are going to be those opportunities if you know how to value companies, if you know how to understand the underlying fundamentals and believe in the management team. But the recent vintages, and I think Marty talked about this yesterday, they are not going to do well. I think it's hard to market time vintages in venture. Venture is a very difficult asset class. You got to be top decile. This notion that you have to be in the top firms in Sand Hill Road is wrong. The data suggests that funds that are large do not perform well. This was shocking to me, but I get a lot of data that's not public because of my San Jose role. But there is actually one data point that someone published. It's a big institutional investor that said mega VC fund performance versus mid to small fund performance, which they define as less than 350 million AUM. Large funds have an average IRR of 9.7% as compared to 17.4% for the smaller funds.
But is that across diversified strategies?
Yes. Yeah. It is so hard to drive a meaningful multiple on $1 billion fund. Right. And if you're going to give someone 2 to 3x, the DPI, so they give you TVPI numbers, but the DPI takes 15 years. So your actual cash flow number in your IRR is spread out over 15 years. You're not getting anything in the first 6 years. If someone gives you 2 or 3x, you're better off being in the triple Q.
Well, thanks, Anurag. I will let our guest from Arizona to talk about the what's going on in the healthcare business.
Yeah,
I'm looking
thanks.
up because we have a screen up here and up.
No,
I'm
I'm
behind
incredibly large head behind you. I can see myself. It's very, very disconcerting. Thank you, Arthur. Yeah, so I think healthcare is obviously undergoing its own set of revolutions, the COVID experience, and I think the sort of disruptive aspects of that entire experience have really driven a lot of change within the industry, and it's in a number of different ways. Obviously, one of them, Gosia already spoke quite a bit about, is AI's application and biobank and bio transformation of diagnostics and therapeutics is just revolutionizing the space. Our expertise, and I think what we're starting to already focus on, is trying to identify those picks and shovels companies that are really going to help build the different kinds of technologies that are out there. CRISPR has gotten a huge amount of press in just the last year, and we've helped to try and identify different companies that we think are going to provide the building blocks, both from chips to AI analysis and other kinds of expertise that are really going to help these CRISPR therapeutics identify in a much more efficient way the right kinds of ideas that are out there. And so we think there's a real opportunity already in these transformative areas to identify the companies that are not necessarily going to be the single breakthrough product, because those are incredibly risky forecasts, but look for those companies that are going to provide, again, the sort of picks and shovels and Levi's overalls for all of the different miners in these different fields. So that's a big part of what we're looking at. And Obviously, 23 and 22 were not the easiest years for any area or any sector, but we're already seeing at the end of 23 and the beginning of 24 a real integration and acquisition rise back in healthcare. So within the digital health space, we're starting to see a lot more acquisitions going on. So, you know, we chose it because we think it's an area of our own expertise. We also think it's one of those areas that is maybe already not too hot, but has the ability to really grow at a more steady rate than some other areas that might be more cyclical over the last, you know, next 10 years. So we're real bullish on it. And we've seen a huge amount of deal flow, even as a pretty early fund here in just the last year.
Thanks, Doug. Peter, you're the guy that actually is behind like the actual total value of the company. So when company comes up with anything in AI or any other business, you need to have an IP, right? This is your source of expertise. And then me as let's say initial startup have a choice of either creating the IP first or raising the money first and then creating IP. How would you address that?
So let me answer that question, then I'll come back if I could use the speaker. Use the microphone to bigger issues at what I see, because so basically IP, anybody, I wasn't able to make it yesterday because of the snow we had, but Marty had a number of companies speak that had a biotech, med device, life science background. And I think I heard more people talking about intellectual property and patents and so on. I said, man, I should have made it into the city yesterday. It would have been worth it. But that's really the value. If you look at a small company these days, especially the early stage companies, the real value proposition is protecting the IP. Now, as we were discussing in the side room there, depending on the technology, there's different ways of doing that. You know, in the software space, it's much more common to do things via what we call trade secret. Because of some Supreme Court decisions and other software issues based on the rapid movement of software, we don't necessarily get patents on that. We can and we do. It's becoming a bigger issue because of some Supreme Court decisions and other things to get patents in the AI space. Clearly, in the life science area, we get that and we protect it. So those are one of the things, obviously, for any early stage companies. We always have to work with budgets and we do things United States and internationally. Years ago, we used to file everywhere, including China. Now we have to be very cognizant of the geopolitical issues. So we don't necessarily file everywhere, including in China. And anybody that recently looked at, read some articles about what's going on with Apple, the Apple Watch and some issues at the International Trade Commission, the firm is actually working on that. So anybody that wants to talk about IP, be happy to. On a much bigger perspective, because as I mentioned 8 years ago, my career somewhat changed where you kind of have to focus on capital. With the family offices that I work with, what we do is we set up the funds. We have an SEC practice with 1,000 attorneys. Overall, we're a general practice. So I have 3 fund formation deals going on right now where we set up the fund. Then we make recommendations to them based on the technology, the intellectual property that we bring to the mix. As Gosia mentioned, AI, and Anurag mentioned, AI is very hot. And then we have a big program of working with universities. And Doug, out there in Arizona, one of our bigger clients is Arizona State and University of Arizona. And the idea is to get the venture capital and the family office money into this space. And then with the work I do with DARPA is to get the non-dilutive money into those companies. So I wrote down a couple of different areas. Anurag mentioned the space. We represent Elon Musk and SpaceX in the low orbit satellite system. Life sciences, spine area is big, especially with the aging population. I think Doug mentioned CRISPR technology, Dr. Jennifer Doudna, who got the Nobel Prize in CRISPR. We see a lot of CRISPR developments that are really exciting. And then just other areas. Quick update, a year ago or so, Marty will remember, we had a Dr. Jeffrey Ling from a company called On Demand Pharmaceuticals spoke. And the technology is about printing generic drugs. It's a lot of developments going on. They had their recent successful trials down in Mississippi, and they're currently being interviewed to be on 60 Minutes to talk about their technology that's going to revolutionize the pharmaceutical industry. Think of it, and this is the last point I'll say, think of it as if you need a drug, you literally just go into, it's going to be like 3D printing for drugs. And it's really advanced technology, working closely with the FDA. And we're handling their intellectual property in many other areas that you'll hear more about as we go forward. Yeah, so Dr. Jeffrey Ling, 30 years Army, on 60 Minutes already several times, several tours of duty in Afghanistan and Iraq, and a lot of supply chain concerns that we had, that we have now that he had back in the actual hospital rooms in Afghanistan and Iraq. Needed certain drugs, couldn't get them, had to, be flown to him and so on. He's got not just a medical degree, he's got a PhD. And he basically, as a chemist, said, these are the certain things that we all need to make drugs. And he started developing technology, licensed it from MIT, and then has been developing it for years. We're doing some work with. Well, there is, as you remember from his presentation, most of the material resources to make drugs come in from China because of the geopolitical issues I mentioned, the work that DARPA does, our government and so on. That's a major concern. So what we're doing is we have the technology now. It's just a thing of scaling it, spreading it out in every hospital system in the United States, and then hopefully around the world we'll have the ability to print whatever drug you need. So yes, to answer Marty's question, and they have a website, On Demand Pharmaceuticals. Right. Exactly. Right now, it's going to be containerization, literally a container at all the different hospitals. As we miniaturize and perfect the technology, it's literally going to be 3D printing on your desk in your office.
Well, thanks, Peter. We noticed recently that there's a trend in the VC and in general that large firms are kind of spinning out little sub firms, and I know that Gosia, you were part of a Softbank, and now you're trying to raise your own fund, and how's that going?
I mean, obviously, it's a very interesting market right now. There is a lot to be said about, I think, Anurag, you had some great stats in terms of the returns that are driven by new funds. There is, in fact, academic research that explains how that works and how, as a new manager, when you go from launching, which generally tends to be a smaller pool of capital, so majority of your compensation really comes from carry, and then over time, as the funds prove themselves, they become bigger and bigger, and it switches over to being more management fee driven. That's kind of how it works. There's this great research done by Jonathan Burke out of Berkeley that explains kind of how he sees it from the macro perspective. But to your point, there's definitely that movement towards emerging managers kind of trying to set up their own shop. I can speak from my experience. It's been a very interesting adventure to be building things for a big firm where they were providing us with capital, but we had to figure out everything else on our own, including the pipeline, the strategy, how we're going to really explore those new markets, because these were new markets for us from the deal flow standpoint, and how we really built the firm and kind of establish ourselves in those markets to be known outside of being known as the big Softbank, being known for the things that we were doing. So it's kind of this natural progression, at least for me personally, to be then taking those learnings and kind of what you should do and what you shouldn't do, and do it on your own. Obviously, the big drivers of those decisions are always the networks that you have built in the meantime and the thesis that you have. I mean, we have been working on this thesis around AI and robotics for the last decade, and together on it for the last, call it 4 to 5 years. So it's actually a funny story. Will and I tried to convince Softbank to give us money for an early stage AI fund in December 2020. And it was before AI was all the rage. It was when crypto was the most exciting area. So it wasn't a successful pitch internally, unfortunately. But that's kind of what really drove us to do it on our own. From the fundraising perspective, I mean, again, it is an interesting market right now. Interest rates are obviously high. So you guys who allocate capital have a lot of choices, but at the same time, the returns, as Anurag mentioned, are higher if you invest in smaller funds and in new hungry managers, if you will. So we're excited to be a part of that crowd.
So continuing on spilling the
I
hopefully
moved
water.
it from there to there. Sorry, I should have warned you.
So anyway, continuing on to conversation about setting up the funds. We noticed that in trends of 2024, there's formation of like a mega funds, but there's, according to your research, there's about 3,000 of the smaller VC firms. So what do you think it's better from the perspective of LPs? Do I want to join like a big ship, or do I go with the smaller guy?
I mean, based on the data, you want to, I mean, oh boy. Is this recorded? Like, will I get in trouble back in Silicon Valley for speaking the truth? I mean, look, the one thing I've learned is not all LPs are motivated only by IRR, which is bizarre to me, because when I got to San Jose and took over the committee, I thought our job was, we were 47% funded to our liabilities, and we needed to improve that number. There are a lot of people who invest in venture for non-linear reasons. And so if you want to be in big funds because they throw amazing annual meetings and you get to say that they're invested in the top companies, that's terrific. But when you actually decompose their ownership percentage in these companies and the size of their portfolios and the actual DPI they drive, I mean, Gosha's right. The data supports being in smaller funds, but here's the challenge. If you're a family office, how do you figure out which of the 3,000 small managers? And I don't know how that's defined. I'm sure it's sub 100 million, but it might even be sub 75. There was a big micro VC rage over the past few years. And what I'll say, I think the CFA accreditation is impressive, but that set of skills that is really useful in analyzing public securities, whether it's debt or equity, is not necessarily well suited to an asset class which is so qualitative. It requires so much pattern matching, and being able to really understand the people and their deal flow and the types of things Gosia talked about that she and her partner are focused on. It takes a lot of work. And even then, you end up with 10 or 20 managers, maybe. You still don't ultimately know what's going to happen.
So is venture like wine? In that, Costco is the largest buyer of wine in the country, and as a result, they determine what's going to be on the store shelves everywhere else. And so venture, you have very famous names, and they take up all of the shelf space. And the small guys have a hard time getting shelf space, in the world of, alternative investors.
Look, I think that's true. I think a lot of large firms are going to come to market in 2024, and they're going to suck the oxygen out of the room. But there's plenty of capital out there, and there are some people who are starting to see this data. I mean, venture it became an asset class in the late 90s when the returns were so outsized. All the consultants told institutions like the San Jose Pension Fund, family offices, endowments, and foundations, you need to have an allocation. Once that happened, a ton of capital flowed into the system, and it was money that just wanted to buy IBM, right? So there's just been this strong emphasis on staying with the brand names. But again, that's not the best way, I think, to build a portfolio that's going to deliver high alpha.
By the way, one more comment. USVP presented to us, they're like a multi-billion-dollar fund, and they decomposed their returns. And they showed that on one fund, they had 10x the returns of all their other funds.
That was probably their 96 vintage, I would guess.
Correct, but I'm saying.
And by the way, I like the USVP, and they have been smart. Their subsequent funds have been smaller and smaller from what they used to be, because I think they're starting to play the game a little bit differently. But yeah, I mean, long time ago when people were getting those because Sequoia's 96 to 98 vintage was like 175 million. Benchmark was about 200 and Kleiner was 200. Those were all 40x plus funds because the internet bubble was God's gift to venture capitalists. That hasn't been recreated in any cycle since.
I'll bring the microphone so we can.
One thing, say the question and then you just repeat.
Oh no, I will forget.
Sure.
We'll go with that.
So a quick question on a portfolio company that's also fundraising, but I don't want to distract from fundraising versus assets. We just had a roll-up of a lot of companies, and we discovered that we have some medical patents that cover medical records, mobile apps, AI, bioinformatics. We also discovered we had about $50 million in 382 exempt NOLs. How could we leverage that without distracting from the funding story, but to utilize that for assets for both investor interest and concerning securing investor returns? I mean, is that like from the IP, is that a sell-off or a licensing? That would be a question for Peter, and for Doug, being able to leverage those assets for, you know, both investor interest and returns. I would like your ideas on how that would kind of.
Peter? Doug, that's question's very hard. You want to start?
Well, as an academic, I can always make up answers
That's a joke,
anytime I
just to give
want.
you the opportunity to speak.
I'll do it real quick, and then I'll defer to somebody who's actually a lawyer, Peter. But, you know, I think from a VC perspective, we've actually run into a few of these kinds of companies. There are a few where they're holding assets into a separate holding company, and that can be separately valued and spun off in a different way. But as you can imagine, from a funding side, we get very skittish when we start seeing, you know, a founder segregating assets and segregating ideas into one part or another. We want to see the unified whole. When we invest, we tend to invest in that founder and all of their ideas. So, you know, spinning those off as a one-off can be a little problematic from a funding perspective, but legally speaking, you know, you can hire Peter. I'm sure he's fantastic. You can get it all done. There's always an answer.
Well, what I'd say is I've done a lot of M&A, especially at a time when I was at Jones Day, and back in the day before they changed the corporate tax laws in the United States, we would always set up a corporate entity in Ireland because they had the most favorable tax regulations, and it was very common. These days, what I'd say, it's still common, but you could do more things in the United States. And then what we're seeing a lot on the IP side, it's just not about getting patents and litigation and more traditional stuff. It's, you know, what is a patent? Not to scare everybody, but a patent's an intellectual property, or what they call intangible assets, but they're assets. So we see a lot more deals where we're using it to have a lot of deals coming to Pete. I have these portfolios of spine-related patents. Can you sell them? Pete, we're selling the company, and the intellectual property is you know, a value proposition to it. You know, how can we get the most of a company from that? Of course, that's a more basic thing, but we're seeing a lot of debt deals where the security asset, the collaterals really is actually the patents and the intellectual property itself. So as Doug mentioned, there's always a solution. Obviously, we would need to dig in and look at it and study it, but it's a very common thing. If you look at some of the bigger companies, their intangible assets are worth in the billions. So we always have to make that part of the deal in any business transaction.
Well, thank you.
I think the biggest problem in VC, private equity, whatever, is finding the deals. It's not a problem, never difficult to get the money for the right deals. The problem is that there are not enough quality deals. I attended a meeting with 20 people sitting around the table. I don't know how many billions was sitting around that table. But the biggest complaint was finding the right deals to get a potential return. What is your view of that situation in terms of, are you seeing the kinds of deals or transactions that warrant and you can generate the kind of revenue or returns? A friend of mine wrote a book on private equity, basically saying that it's not what it's cracked up to be. And he's a professor at Johns Hopkins. So to what extent is this somewhat fiction, and to what extent is it real?
I'm going to deal with that question. Well, okay, well, it's definitely not fiction, but I think it's, so yeah, 100% not fiction. It can't be fiction. I mean, yeah, look at what innovation has done. I mean, all of us who've done very well in the S&P 500 in our 401k plans, it was 8 tech stocks that drove it, and 7 of them, I think, were venture backed. So it is not a fiction. Venture capital has created a construct, though, that's got a lot of crap in it. And that crap creates friction when you try to capitalize on the alpha that you get out of innovation. So I'm not going to lie about that either. But are there deals there that, I mean, I don't know how Gosia and I are like, either you are part of our world and you know they're there, or you don't. I mean, it's hard to go convince an audience that is so removed from it. And I find that with investors, there's folks like, I don't get it, so I'm just not going to do it. That's fine. And then there's people who try to get it and they don't fully put the trust in people like Gosia or other managers who actually are out there. You're not going to have every company hitting an early stage fund. You know, you need to pick the basket and then know how to drive them to their next set of milestones, continually setting, and it's hard work, right? But at the end of it, you just need 4 or 5 companies. It's a real power law curve. So do those exist? Absolutely. Yeah. I mean,
I wanted to ask Doug because, you know, Doug is in hot Arizona and then, you know, and then Silicon Valley. How do you pick, I mean, how do you get a hot deal flow in Arizona is actually continuation to that question, right? How do
Yeah,
you
one of
find?
the, no problem. And, you know, it actually connects a little bit to Peter's point of, you know, Arizona has been investing, especially in healthcare, but in semiconductors and energy and water for decades. And the real issue has been, there's been a lack of venture in Arizona. We're 1 year old. We just had our first anniversary of our first close, still raising, by the way. And we, I think, are now the 3rd oldest VC firm in Arizona. So the real issue was the deals were all just flowing out into California. And so part of what's finally changed a little bit is the Build Back Better program, leaving politics out of it. That was more last panel. You know, I just think that provided some early stage funding for venture capital firms like ours to really get off the ground in a place like Arizona. So the deals have been there. I think the answer is that those deals have always flowed out to California. What's really interesting for us, and I agree with the last person's question, whatever you have in terms of your financial background and the incredible financial analysis. I met a VC, I won't name who says he has 75-page spreadsheets on every single company. And I keep telling him, you know, if you've got a formula you can sell, you'd be the richest person in the world. It's not a formula. It's the right deals. It's the ability to drive those deals into success. It's the ability to connect your founders to other people to really help move them forward. It's more of an advisory aspect than anything else. And I think that's what's difficult for people to really get. So what we're finding are a lot of California companies, and you can look at our portfolio, it's online. We've got 11 companies in a year. Only 3 of them are in Arizona. We've convinced 3 to now move to Arizona from other states because it's a lot cheaper to live in Arizona. There's an amazing labor force. And of course, you live where your capital is. You know, that's what's happening is if you've got capital in Arizona, deals are going to start coming to a state like Arizona. So that's been our experience in just the last year. It's nascent, you know, we're new, but we're definitely seeing that possibility. So deal flow is everything. You know, we're not financial experts. We have people on our team that are. We're 3 guys that can source deal. And last thing I'll say, Peter, is one of the greatest areas to get deal flow is law firms. And that has been where I think probably 40 to 50% of our deals have come from, is just me reaching out to major law firms around the country. They recommend clients to us. It's been a real great source of deal flow for us.
I've actually never heard that. I like that thing. Doug is my new friend. Yeah.
I just want to
Thank you,
jump in for one quick second. So I just have to agree with Doug. We've done a lot of stuff in Arizona in the past. It's a very mature system of entrepreneurs and small amounts of capital. And I mean, it's like Austin, Texas used to be, where there was only Austin Ventures back 20 years ago. And now Arizona's in that stage. So kudos. But I think that venture has kind of been junked up. I think it's harder to find that needle in the haystack if you're the big VC or you're the, you know, older VC. And then there were so many micro VCs because of cheap rates for years. And all these guys are like alumni of whatever incubator or accelerator there is, right? And they're looking out for deals first. But the way they construct it might mess up a deal, right? I think people don't look at capital stack enough on these venture deals. A lot of crowdfunded deals, a lot of deals where there's the wrong people on the capital stack, and people will stay away from deals where there's the wrong people on the capital stack, or you can't do a cram down to fix a deal, you know, et cetera. Can you give your thoughts on that?
I agree with, I don't invest in any deal that I don't like the cap table. I don't know the people. By the way, there's big time VCs I avoid too, because they're pains to deal with. And you don't have to be in their deals. I mean, everyone thought you had to. So yeah, I mean, I want Gosia to get a chance to comment on this, but the bottom line is absolutely who's on the cap table matters.
We've got so many Y Combinator like come to us saying, we're micro VC now. and then they're just investing in every deal and
One-
it messes up the stuff.
One more comment on the micro. One of the problems, they were raising money and coming to me 2016, 17, 18. And I'd ask them, okay, $50 million fund, what's your dry reserve policy? And they look at me like I have a hole in my head. I'm like, yeah, no, you didn't live through the great financial crisis or the NASDAQ bubble where you have to protect your investment. Most of those funds are going to see their portfolios obliterated. I mean, there are some micro VC GPs who basically aren't working anymore because they know their portfolio is not worth anything. So yeah, you have to stay away from, I mean, this is why having been burned through 2 cycles actually ends up having some value because you know that who you're invested with matters and whether or not they're in it for the long run.
Let's say you're a family office and you're on the capital stack of the deal. There's 100, co-investors in it, small investors, and you're like saying, I can fix this deal and help it survive to the next round. But there has to be a grant on with everybody else, and they're gonna litigate, and I don't wanna get involved in litigating with a guy who's invested $25,000 in a deal.
I don't see a lot of litigation on cram downs, so,
No,
yeah,
Yeah.
but I mean, that's tough. I mean,
there has been a lot of those smaller checks. I think the founders have gotten recently kind of over the last couple of years smarter about it, and they have been trying to put the kind of small angel checks that are not happening at the pre-seed stage, but a little bit later into SPVs. So they would give an SPV allocation to someone, and then those folks would be filling in the round with those $25,000 checks. That helps a little bit. And it's, there's like a market standard in terms of how much equity a founder should have after each round, how much dilution you should take. And the high quality founders tend to know those things, tend to be in the right networks. Oftentimes we see that. I can see skepticism on your face, Marty. I think that there is more than you would think. It is a lot of it is about getting the right advice. And particularly there is the pool of if you're in Silicon Valley, investors, you can get a sense of how you should structure your cap table from the early innings. You have friends who can advise you on that. So it's not like this information is not available, and founders do tend to know it. And if they haven't, and the cap table is not that great, then there are ways to fix it. You try to get a high quality lead who will help you. You might fail, and yes, a bad cap table can screw you as a founder, but it's not. I don't see that as being that big of a problem, especially when as an investor you're going for high quality deals. One other comment I would make is, so we talk a lot about deal flow and how being in the right rooms is very important, and it absolutely is, right? Because you want to see within your addressable landscape as an investor, as a fund manager, you want to see kind of everything or most of the things that fit your criteria. You can do it by having the right networks, being in the right rooms with founders and fellow investors. To some extent, technology starts to assist with that too. And I don't mean PitchBook, but there are some more specialized services that kind of help with deal flow on a more kind of quantitative basis. One thing that I think tends to be forgotten a little bit in terms of choosing fund managers, if you will, is just the sheer quality of execution that they are able to provide. Because seeing all the right deals is one thing, but then you need to trust in those people that they will be able to diligence them appropriately, to check those cap tables too, to try to evaluate both the quality of the founders, the quality of the idea, the references, their customers list, do some math on it. There's like a basic kind of work that goes into the diligence process, which funds tend to have staff experience in doing it. And it's very important. And only then you really get to the stage where you're helping the founders execute. And that's another lever that's very important. That's very important too.
The only thing I'll add is I feel like my career is pretty cool is on the deal side. I'm a deal guy. So that's what it gets exciting, although I focus on the IP and patents. So we mentioned the company On Demand Pharmaceuticals. That's going to be printing generic drugs. That's really exciting technology. Just to throw some others out there, if anyone's interested, just let me know. There's a company, Paterna Biosciences. They raised $3 million from KKR. KKR bought another fertility company for almost $3 billion just last year, IvyFON. So after we get some good data and results, that company is going to be doing really well. Very good founders. Licensed technology from University of Utah, so not necessarily Northern California, as Doug was mentioning. So we're seeing a lot more developments around the country on that. If you look at another company actually in Utah, it's called Dysgenics. There's a lot of fusion surgeries going on with the spine. This is just new proprietary technology to inject to regrow the disc rather than fuse them. So they're doing really well. They're finishing up a $50 million round, and they'll probably do an IPO, get acquired in a few years. And then with the work I do with DARPA, I see tremendous amount of deal flow, more on the national security side, quantum computing, cybersecurity, AI, of course. The gentleman mentioned yesterday, people talk about DARPA, they don't mention ARPA-E for energy and ARPA-H for health. One of the gentlemen yesterday mentioned he received $62 million in non-dilutive funding from ARPA-H, which I hope the healthcare group later on today when they talk, they mention that because there's a lot of non-dilutive money there. That's exciting. Then although Doug was very nice in mentioning that he gets a good deal flow from law firms, definitely got to introduce him to my team in Arizona. We actually get a lot of deal flow from universities, and I think that's the tech transfer groups, working closely with them. I just spoke 2 weeks ago with Kevin McGovern, who was very active in the family office space, to about 25 PhDs at Weill Cornell. We spoke to the tech transfer group over there, just all about deal flow. It is with the venture capital, patient capital, it's not something that's going to happen overnight. But, there's a lot of deal flow out there, and you just got to go to credit to Marty, because these events, you got to go and you got to get involved and see where these deals are coming out of.
Well, thanks, Peter. Just, oh,
Yeah.
you're taking my questions.
Why is space the greatest thing since sliced bread?
I wouldn't say it's the greatest thing since sliced bread, but I'd say it's like a theme that I'm definitely excited about. Why? Because it's a market. I mean, the technologies that will go into the space tech market are platform technologies that'll be used for other sorts of things. But the opportunity is huge. So there's and this, I'm going to make 2 points, yours and then a broader point, answer your question and then a broader point. There is a Mandela Space Ventures is an accelerator based in Pasadena, affiliated with JPL and Caltech. The Silicon Valley of space tech in the United States is Southern California because of all the defense contractors down there, right? So you get 2 brilliant PhDs out of Caltech who have some idea on how to build a data center that orbits the Earth and is 1/10 the energy consumption because it'll all be solar, right? We're going to need more data centers, and for the ESG folks, those are a very pollutive infrastructure. So now these 2 PhDs, their ability to turn an idea into a product, okay, maybe, but then to build a company, that's a tough bet to make. You need an ecosystem around them, and so these Mandela guys are the best space tech ecosystem I've seen. Canada just gave them their sovereign accelerator to manage. There's 2 countries in the UK about to announce, I can't say who they are, who will do the same thing. When you surround yourself with an ecosystem, it takes a village for a startup, right? It's not just 2 people or 3 people inventing a product. You need good investors and people who are making all those introductions. So when I see an outfit like that with the capacity that Southern California has, and I see all the market opportunity, I get excited and think it's thematically a good place to be looking. But there's a lot of technology risk.
So, Marty, we still have a 1 minute or what? How are we doing? No. Well, thank you very much. Great panel, and we'll
Thank you
see
very
next
much.
time.
Thank you, everybody.